Have you been napping when you should be preparing for the IPO? Well, if you have incentive stock options, this is the video for you. If your company is gearing up for that IPO, stay tuned for what comes next. First, let's define what incentive stock options are. IPOs are a type of stock option issued as part of an employee's stock option plan. And incentive stock options offer tax benefits when you exercise the option and hold the underlying shares for a longer time period. We might have a drinking game here. Options have an exercise price, generally the share price on the day of the grant, and a vesting schedule. As the options vest, you are allowed to purchase the option and receive company stock. The vesting schedule is generally over a 4-year time frame, and the options will have a set expiration date. The expiration date is the date you must exercise your options by. If you do not exercise your options by the expiration date, then they'll terminate. The expiration date may depend on whether you are still employed with the company or if you've terminated employment. For many options agreements, we see you have 10 years to exercise your options if you're still employed. However, if you've left the company, this time frame most likely changed. We often see that this is shortened to the sooner of an IPO or within 90 days of terminated employment. If you are gearing up for an IPO and left the company earlier, break out that options agreement to ensure you are following the correct timelines. We've seen this happen in recent IPOs. So let's talk about taxes. Before we dive into the IPO conversation, let's do with a quick recap of how IPOs work. Incentive stock options are a little bit different than non-qualified stock options. Although these are both types of stock options, non-qualified stock options do not have the same tax benefits. Non-qualified stock options are considered compensation income at the time of exercise. Exercise, not sale. The theory is that you are receiving an implicit value at that time. So you will recognize ordinary income the year of exercise at the difference between the stock's value and the exercise price. Non-qualified stock options are provided in the early days of a startup before an ISO plan has been formalized to advisors, and they're considered if you have a disqualifying ISO position. So what are the specific requirements for that? ISOs are part of a qualified stock option plan and are eligible for long-term capital gains treatment. Because they may receive favorable tax treatment compared to non-qualified stock options, ISOs also have limitations. You can only receive up to $100,000 in ISO value within a current year. If an employee receives more than $100,000 worth of exercisable ISOs in a given calendar year, the remainder above $100,000 will be considered non-qualified stock options. This is why you may see a split vesting schedule in the later years of your ISO grant. So review your vesting schedule to determine how much of the original grant maintained ISO status. ISOs are only eligible for special tax treatment if they are exercised and held at least 1 year from exercise date and 2 years from grant date. The special treatment allowing qualifying ISOs to be sold at long-term capital gains rates on the value is really about how long that time component has been. No component above the exercise price is then going to be sourced back to compensation income if you met the holding period. And that's huge! Long-term gains treatment, compensation income. If you do not meet the holding period, then the ISOs are now not qualified and become ordinary income again. Long-term tax treatment sounds great, but there's a catch. ISOs are still going to go through what's called the Alternative Minimum Tax System, or AMT, the year of exercise. This is a parallel tax system that runs through your tax information annually and adds back certain preference items. The value between the current market price and the exercise price is what they call the bargain element, and this is added back to compute AMT. At smaller bargain elements, you may not have noticed ISOs went through this AMT calculation. It kind of stays behind the scenes until, boop, you owe AMT. As you look at exercising larger ISO tranches, this is when you may suddenly have an additional tax due on your return. The goal of AMT was meant to keep certain tax avoidance pros from getting too too good of a deal. Unfortunately, these rules are far older than when the tech industry decided to really start ramping up use of ISOs. It's important to make sure a tax accountant with experience in this type of situation is in your corner. We've seen AMT easily get up to over $250,000 when exercising 1 million of ISOs in value. And again, that's at exercise, not at sale. So where's the opportunity in using these tax advantages with an IPO? An IPO, or initial public offering, is when a company first sells its shares on the public stock market. This can be a significant financial opportunity for employees if they have ISOs and a liquid market to sell their shares. Exercising your ISOs before an IPO can be advantageous too. By doing so, you lock in a potential lower stock price and begin the long-term capital gain treatment clock. However, it's important to consider the risks as well. By exercising stock options pre-IPO, you are signing up for a roller coaster of emotions for the first year on the public market. NASDAQ published a study in April 2021 analyzing IPO first-day returns versus the long-term IPO outcomes. IPO returns deviated significantly by the end of their first year on the stock market. 34% of IPOs were above their IPO price by about 10% or more, but over 50% of IPOs were below their IPO price by 10% or more. And remember, this analysis was done during a heyday for IPOs. These are real risks to consider. So, when should you exercise your ISOs? If your company is talking about an IPO in the next 18 months, that might be a great time to look at what cash you can afford to put at risk. The total cash should include what it costs to exercise your ISOs, plus any alternative minimum taxes you would need to pay. If you can put some cash towards annual exercises, you may be able to spread out the AMT cost, capture additional exemptions, and minimize your risk of over-indexing on a delayed IPO. It's crucial to evaluate your financial situation and your risk tolerance before making a decision. So let's look at a case study. Jane, an employee at a tech startup, decided to exercise her ISOs before the company's IPO. We'll walk through her decision-making process, a little bit of the financial impact, and how she's thinking about that outcome with the IPO. Jane is a long-term employee who joined around 7 years ago. She received 2 ISO grants, one grant of 10,000 shares at an exercise price of 10 cents. She originally early exercised these stock options with an 83B election. Since she exercised them when the value was 10 cents when she received it, so exercise price 10 cents, value 10 cents, no bargain element, she didn't pay any alternative minimum tax. She also held these shares for more than 5 years. So our next step is to look into something new, something called the Qualified Small Business Stock Exclusion. This could help her eliminate up to $10 million in capital gains taxes at the federal level. But note, California does not follow this federal exclusion, and other states may not as well. So let's move on to the second grant of 10,000 shares again, but at an exercise price of $3 from about 5 years ago. Since she had already exercised one grant, she felt a little weird spending $30,000 in exercise costs, considering maybe that wasn't the best for her financial situation at the time. And then after that, she began receiving double trigger RSUs for stock compensation. So she wanted to know what to do with this remaining ISO grant, in light of the fact that her company just filed the S1. My questions to her were, how much cash are you comfortable putting towards the ISOs now? What is the current 409A valuation of the company? This is important for calculating the bargain element for AMT purposes. What is the expected IPO price range for the stock? Do they expect it to be about the same, higher, lower? Jane and I worked together to understand how much cash she could put towards the stock from a risk perspective. We reviewed her emergency savings, other investments, and expected expenses over the next few years to make sure she would feel financially comfortable. Through this, we determined around $10,000 could go towards this type of high-risk investment. The current 409A valuation is $58 a share, and she expects the IPO to be about the same range in price. Her double trigger RSUs agreement lets us know her shares will be considered income at the end of the first day of the IPO. So based on her income, For this year, we decided to exercise some ISOs to make the most out of the AMT exemption and the calculation there. Then, we would decide how many more to exercise once the RSUs were sold as part of the IPO. The higher your taxable income is in a given year, the more impact there may be from an AMT perspective. So we ran a few scenarios to know what the outcomes might look like. This way, we did not put her future cash flow at risk. We utilized what she can afford now, and then prepared to make another purchase as well when the RSUs sell. The RSU sale will allow us to leverage into more ISOs comfortably. It's essential to work with a financial advisor or tax professional to develop a strategy that fits your specific situation. They can help you navigate the complexities and ensure you're making informed decisions. Exercising ISOs in anticipation of an IPO can be a smart move. It requires careful planning and consideration of the risks and tax implications. If you found this video helpful, give us a thumbs up and subscribe for more financial insights. And thank you for watching. If you have any questions or other topics you'd like for us to cover, please leave a comment below. And don't forget to check out other videos for more great advice. Until next time, go forth and grow your wealth.